Hello everyone. In this video, we will discuss about some of the manifestations of the globalization of world capital market. First of all, what is globalization? Globalization is the word used to describe the growing interdependence of the world's economies, cultures, and populations, brought about by cross-border trade in goods and services, technology, and flows of investment, people, and information. Globalization has led to a number of significant changes in the world, including increased economic growth, greater cultural exchange, and increased political cooperation. It also raised concerns about issues such as inequality, the loss of cultural identity, and the exploitation of workers. The term globalization is often used to refer to both the positive and negative effect of this process. Next, we move to the word capital market. It refers to the global network of financial institutions, exchange, and market, where securities such as stocks, bonds, and other financial instruments. It includes both primary market, where new securities are issued and sold to investors, and secondary market, where existing securities are traded between investors. However, the world capital markets also pose risks, such as the potential for systematic financial crisis, and require effective regulation to ensure their stability and integrity. And now, the most important part. We will discuss some of the manifestations of the globalization of world capital market. It has led to a number of significant manifestations, including increased cross-border investment. One of the most significant manifestations is the increased cross-border investment. This had allowed investors to diversify their portfolios across countries and regions, and had led to a significant increase in foreign direct investment. It referred to a growing change in investors buying and selling financial assets across borders. This is made possible by advancement in technology and communication. For example, the rise of foreign direct investment. FDI occurs when a company or individual invests in a foreign company or establish a subsidiary or branch in a foreign country. This type of investment has become increasingly common in recent years as companies seek to expand their market reach and take advantage of lower labor and production costs in other countries. Another example is the growth of international portfolio investment. This refers to the purchase of stocks, bonds, and other financial assets in foreign markets. This type of investment allows investors to diversify their portfolios and potentially earn higher returns by investing in markets with higher growth potential. Also, the expansion of sovereign wealth funds is a result of international investment. Governments or organizations with a governmental connection own sovereign wealth funds, which are used to invest in a range of financial assets globally. Many nations use these funds to generate income and diversify their reserves, making them key actors in global financial system. The second is integration of financial markets. The globalization of world capital markets has led to an increased integration of financial markets. This has allowed for the efficient allocation of capital across borders and has lowered the cost of capital for companies. It refers to the process of linking financial markets across different countries and regions, leading to greater interconnection and interdependence between them. Take the growth of international stock exchange as an example. Many countries have established stock exchange that allow investors to buy and sell shares in companies listed on those exchanges. These exchanges have become increasingly interconnected, with investors able to trade shares in foreign companies from their home countries. Another example is the growth of international banking. Many banks operate across borders, offering a range of financial services to customers in different countries. This had led to the development of global financial networks, facilitating the movement of capital across borders and allowing for the efficient allocation of resources. The third is increased competition. The globalization of world capital market had led to an increased competition among countries and companies. This had led to a race to the bottom in terms of taxation, regulation, and labor standards, as countries and companies seek to attract investment. It refers to the growing competition among countries and companies around the world for investment, trade, and market share. In terms of taxation, many countries have lowered their corporate tax rate in order to attract investment and remain competitive in the global economy. This has created a competition among countries to offer the most favorable tax environment for business, which can lead to decreased government revenue and reduced public services. Another example of increased competition is the competition among countries to attract foreign direct investment (FDI). Countries may offer various incentives to foreign investors, such as tax breaks or subsidies to encourage investment, which can benefit investors but may also lead to reduced labor standards and environmental regulations. The fourth is increased volatility. This is due to the increased interconnectedness of financial market, as well as the rapid movement of capital across borders. It's related to tendency of financial market to experience greater fluctuation in asset price and exchange rate, often leading to increased uncertainty and risk. For example, the 2008 financial crisis was triggered by the collapse of the US housing market, but quickly spread to other countries and regions around the world, leading to a global recession. This illustrates how quickly financial shocks can spread across borders and affect the global economy. Next is the greater risk sharing. It has been a consequence of the globalization of world capital market, which has allowed for greater diversification of portfolios and the sharing of risk among investors. Another example is the development of international financial institutions, such as the International Monetary Fund and the World Bank. These institutions provide financing and support to countries facing economic instability or crisis, which can help to stabilize financial markets. The last is influence of multinational corporations. One example is their ability to shape national and international policy. MNC have significant resources and can use their economic power to influence government policy, often in their own interest. This can lead to a situation where national governments are forced to compete with each other to attract investment. Finally, in the conclusion, we will summarize the key points. The globalization of world capital market has far-reaching effects on the global economy, with both positive and negative consequences. While it has to increase cross-border investment and greater risk sharing, it has also led to increased competition and volatility and has given rise to powerful multinational corporations with significant influence over the global economy. So this is the end of our video. Thank you so much for your listening, and we appreciate that so much. We hope this video brings some useful knowledge to you, and if you have any questions, please let us know. Thank you and see you. Bye.